If you have money in silver right now, or if you're watching oil prices climb and wondering whether this is the beginning of something much bigger, there's a situation unfolding between the United States and Iran that you need to understand. Hey everyone, welcome back. I'm Bernard Ortega, and if you've been following the news over the past few weeks, you know that something significant is developing in the Middle East. President Trump has ramped up what he calls his maximum pressure campaign against Iran. He's reimposed severe sanctions, he's issued direct warnings, and just this week, he used the phrase locked and loaded when talking about potential U.S. military action if Iran continues certain behaviors. According to sources inside the administration, there's now a 90% chance of kinetic military action against Iran within the next few weeks. Markets have responded exactly the way you'd expect them to when geopolitical risk spikes this dramatically. Silver, which has been on an extraordinary run for months, hit over $90 an ounce earlier this month. That's a level most analysts didn't think we'd see this year, let alone this soon. Oil jumped 4.5% in a single trading session after Vice President Vance said Iran had ignored key U.S. demands and that military strikes remain on the table. And if you look at how commodities have moved over the past several weeks, the pattern is unmistakable. Every time the rhetoric escalates, prices react. So today I want to do what I always try to do on this channel. I want to cut through the noise, explain what's actually driving these moves, and help you understand what it really means if you're someone who's just trying to manage your money responsibly in what feels like an increasingly uncertain world. We're going to talk about silver, oil, the relationship between geopolitical risk and commodity markets, and most importantly, how to think about this situation without either panicking or ignoring something that genuinely matters. Let's start with the facts on the ground because it's important to separate what's actually happening from what's speculation or fear. Trump took office in January of this year, and one of his first major foreign policy moves was to restore what he calls maximum pressure on Iran. That's the same approach he took during his first term, and it involves a combination of economic sanctions, diplomatic isolation, and the threat of military force. The goal, at least as stated publicly, is to force Iran to dismantle its nuclear program, stop supporting militant groups in the region, and fundamentally change its behavior on the international stage. Iran, for its part, has not responded the way the Trump administration hoped. The country has continued advancing its nuclear program. It's continued supporting proxy forces in places like Yemen, Lebanon, and Iraq. And over the past few weeks, there have been mass protests inside Iran over economic conditions and government repression. Trump has issued direct warnings about those protests, saying the U.S. is locked and loaded and will take very strong action if Iran hangs protesters or continues killing demonstrators. That's not diplomatic language, that's the language of imminent confrontation. On top of that, there have been high-level meetings. Trump's advisors, including Jared Kushner and Steve Witkoff, met with Iran's foreign minister in Geneva just this week. But according to reports, the gaps between the two sides remain wide, and U.S. officials are not optimistic about reaching any kind of agreement. And then there are the sources inside the administration who are now saying there's a 90% probability of military strikes within the next few weeks. That's not coming from random analysts. That's coming from people who are close to the decision-making process. Now, does that mean war is inevitable? No. But it does mean the risk is real, it's elevated, and it's being taken seriously by people who have access to information that the rest of us don't. And markets are reacting accordingly. Let's talk about silver because this is the move that's caught a lot of people's attention. Silver hit $90.54 an ounce on February 4th. Just a week later, on February 11th, it was still trading above $84. To put that in perspective, a year ago, silver was trading around $40. That's more than a 150% gain in 12 months. And while silver has been in a strong uptrend for a while now, the most recent spike is directly tied to what's happening with Iran. Every time tensions escalate, silver moves higher. Every time there's a cooling off period, it pulls back slightly, but the overall trajectory has been sharply upward. Silver, like gold, is what traders call a safe haven asset. When uncertainty rises, whether it's economic uncertainty, political instability, or the threat of military conflict, investors move capital out of riskier assets and into things that are perceived as stores of value. Gold is the classic example of this, but silver benefits as well. And in some cases, silver benefits more dramatically than gold because it's a smaller, more volatile market. It doesn't take as much money flowing in to move the price. When fear spikes, silver can move fast. But here's what's important to understand. Silver isn't just reacting to the possibility of war. It's reacting to a broader environment of uncertainty and monetary instability. Central banks around the world have been buying gold at record levels. Inflation, while it's cooled from its peak, is still running higher than it was for most of the past 2 decades. And there's a growing sense among certain investors that the global financial system is more fragile than it appears on the surface. Iran is the catalyst right now, but the underlying conditions were already in place for precious metals to perform well. So if you own silver, either as physical metal or through an ETF or mining stocks, you've probably seen significant gains over the past year. That feels good. But it's worth remembering that what goes up on fear can come down just as quickly if the situation de-escalates or if markets decide the risk was overpriced. Silver is volatile. It's not a set-it-and-forget-it asset unless you're holding it as a very long-term hedge against systemic risk. If you're trading it or holding it as part of a tactical allocation, this is a moment to be clear-eyed about your strategy. Are you holding because you believe in the long-term case for precious metals, or are you holding because the price is moving and you don't want to miss out? Those are very different positions and they require different approaches. Now let's talk about oil, because the 4.5% jump in oil prices tells a different story, and it's one that's more directly tied to the specifics of this situation. U.S. crude oil rose $2.86, or 4.59%, to close at $65.19 per barrel on Wednesday. That move came right after Vice President Vance's comments about Iran ignoring U.S. demands and the possibility of military strikes remaining on the table. That's a meaningful one-day move in a commodity as large and liquid as oil, and it happened for a very specific reason. Iran is a major oil producer. It's one of the largest producers in OPEC. And even though its output has been constrained by sanctions for years, it still plays a significant role in global supply. More importantly, Iran sits on the Strait of Hormuz, which is one of the most critical choke points for global oil shipping. Roughly 20% of the world's oil passes through the Strait of Hormuz on its way to market. If Iran were to close or disrupt that passage, or if a conflict in the region threatened shipping lanes, the impact on global oil supply would be immediate and severe. When Trump or any senior U.S. official makes statements that increase the perceived risk of conflict involving Iran, oil markets react because traders are pricing in the possibility of supply disruption. It doesn't mean supply is actually being disrupted right now. It means the probability of disruption has increased, and that probability gets reflected in the price. A 4.5% move in oil represents billions of dollars changing hands, and a meaningful shift in how market participants are thinking about near-term risk. There's also a forward-looking component to this that's worth understanding. Commodity markets don't just react to what's happening today. They're trying to anticipate what could happen in the weeks and months ahead. When a credible threat emerges, and by credible I mean a threat that has even a reasonable chance of escalating, markets start pricing that in before anything actually happens. That's why you can see oil spike on a statement or a warning, even if no actual military action has occurred yet. Earlier this month, oil jumped over 3% after Trump warned Iran's supreme leader that he should be very worried. The market is paying attention to every signal, every statement, every move. So does this mean war is actually coming? Honestly, no one outside of a very small circle of decision makers knows for sure. And even they may not know, because these situations evolve quickly and unpredictably. What we can say is that the risk has increased significantly. The rhetoric is sharper than it's been in years. The military posture is more aggressive. And the timeline that insiders are talking about is measured in weeks, not months or years. But there's still a long way between elevated tension and actual military conflict. Governments, even hostile ones, have strong incentives to avoid open war. Wars are expensive, unpredictable, and tend to spiral in ways that no one fully controls. Diplomacy, back-channel negotiations, and last-minute de-escalation are all still possible. That doesn't mean they'll happen. It just means that the distance between where we are now and a shooting war is not as short as some of the more breathless headlines make it sound. What's more useful to focus on if you're an investor or someone trying to make sense of your financial situation is not whether war is inevitable, but how to think about the volatility and uncertainty that comes with situations like this. Because this is not the first time geopolitical risk has spiked, and it will not be the last. Markets go through cycles of calm and tension, and understanding how to navigate those cycles is more valuable than trying to predict any single event. Let's talk practically about what this means. If you're exposed to energy or oil-related investments, the recent moves have likely been favorable for your positions. Energy stocks, oil ETFs, and related sectors tend to perform well when oil prices rise. But those gains are tied to a specific risk scenario. If the situation with Iran cools, or if other producers step in to fill any perceived gap, oil could just as easily give back those gains. That's not a reason to panic or sell everything. It's just a reason to stay aware of what's driving your returns and to make sure your position size reflects your actual risk tolerance. If you're not directly exposed to silver or oil, but you're just watching this unfold and wondering what it means for the broader economy or for your savings, the main takeaway is this: geopolitical risk is real, but it's also something markets are designed to price in over time. Markets are messy, they overreact, they underreact, and then they adjust. The key is not to let short-term volatility, whether it's a spike in commodities or a sell-off in stocks, push you into making emotional decisions that don't serve your long-term goals. One other thing worth mentioning, and this ties back to what we've talked about in previous videos. When commodities like silver and oil spike on geopolitical fear, that can have ripple effects across the economy. Higher oil prices mean higher transportation costs, which can feed into inflation. If inflation picks back up, that puts pressure on the Federal Reserve, which then affects interest rates, which then affects everything from mortgage rates to savings account yields. It's all connected. And while any single geopolitical event might resolve without triggering a broader cascade, it's useful to understand how these pieces fit together so you're not blindsided when one thing leads to another. So here's where we are. Trump has warned Iran. The US is locked and loaded. Silver hit $90. Oil spiked 4.5%, and sources are talking about a 90% chance of military action within weeks. Markets are reacting to an increase in perceived geopolitical risk, not to the certainty of war, but to the real and elevated possibility of it. Whether that risk materializes into something more serious remains to be seen. What matters for you, as someone managing your own financial life, is understanding why these moves happen, what they signal, and how to think about them in the context of your broader strategy. Don't panic, don't ignore it. Just stay informed, stay calm, and make sure the decisions you're making today are aligned with the goals you have for tomorrow. I hope this helped clarify what's going on and why it matters. If you found it useful, share it with someone who might benefit. And as always, if you have questions or want me to dig into something specific in a future video, let me know. I'm Bernard Ortega. Stay informed, stay calm, and I'll see you in the next one. Nothing in this video is financial advice. I'm not a financial advisor, and I don't know your personal situation. The information presented here is for educational purposes only. Always do your own research and consult with a qualified financial professional before making any investment decisions.